Welcome to the daily update, where I'll go over the action in the market for Monday, August 11th, and we'll see how things look for Tuesday, August 12th. Well, we set a pretty nice intraday high, but that was where it was set. And then we saw a lot of selling as we were coming down going into the close. Now, some of that could be understandable. We have CPI coming out on Tuesday. Market's had a pretty good run. There's really no conviction going on. We don't have anything really extreme positive or negative right now on our list. And we're in the middle of summer and we're below average with volume. Not a real surprise there. We're also in a historically, or should I say, an historically seasonal weaker time. Hasn't really materialized yet. I started watching this about halfway through July when we were setting new all-time highs. Doesn't mean that's going to happen, but we just start watching for it. It's nice to know about something ahead of time, and that hasn't materialized. Excuse me, that hasn't materialized at least to this point. It still could, but when you get everybody thinking, yeah, we're going to go down in August and September, quite often the opposite is what ends up happening. That's why, with all the indicators, with all the interpretations, with all the ways that we look at different charts, price is the ultimate indicator, and we have to follow price. Now, it turned a little bit weaker in Monday's session. We've got a lot of stuff hitting the market, geopolitical things. There are talks going on between Putin and Russia. That'll be happening later. We've got CPI, PPI, retail sales. We have tariff things that are happening. It's a lot for the market to digest. Didn't seem to have that much of an impact on Monday. And rather than buy, at least after the open, folks decided to go ahead and sell. All right, so right at the open, we did have a higher open. The futures were fairly positive, not that much, but it produced a higher open. And then right after the open, we chopped above and below the unchanged level. And then it seemed like, okay, here's some conviction coming into the market. We were able to rise up to R1 at 64.05. So now we're back to dealing with 6,400, at least for a little while. But that ended up setting the intraday high. Then after that, and this is when I really start to watch the market, right around lunchtime or a little bit after. There's no real set time, but usually when the morning session ends and the afternoon session picks up, that's when the smart money comes in and does what they're going to do, whether it's buy or sell. We saw selling. Prices declined below the unchanged level, so we went negative, got below the daily pivot at 63.80, but we did find support at S1, 63.65. That's what I love about these pivot points. We know them ahead of time. I post them on the YouTube community tab. I post them on the website. We know about them, and it's surprising, or just astonishes me anyway, that day after day after day, these points are really pretty significant. But then we were able to close above R1. All right, so we were down just 0.25% on a percentage basis. Not that big of a change. And we were below average with volume. Now we're still positive on all time frames. We're above the 20 period, 50 period, and 200 period moving averages. When we're above those, that means that we're positive in the short, intermediate, and long term. And we're going to get a real take on inflation in Tuesday's session with CPI. Now, in my opinion, the employment report, that's the most important economic report of the month. Then the second most important is CPI. The other ones, PPI, retail sales, all of that, those are also very important, but these seem to be the two heavy hitters. And we did see interest rates changing a little bit there. I'll go through that in just a moment. And a lot of geopolitical things that are happening right now. So, some comments. We did have early gains in Monday's session. It led to all-time highs, especially not for the S&P, but for the NASDAQ and NASDAQ 100. But then we started going down after that. The markets are dealing with a lot of stuff. Tariff extensions, because it came out, there's not going to be any extensions. There's no deviance from what we've already said. Well, Trump's also a negotiator, and it's like, okay, if you're willing to sit down and talk, we're willing to sit down and talk too and see if we can come up with something. So there have been some tariff extensions, rate cut expectations. The market, if you watch the weekly video and I go over the what's called the Fed Watch tool, and they're pretty much expecting that there's going to be a 25 basis point cut in September and possibly even one more as we finish out 2025. Geopolitical summits, Putin, Russia meeting to get, or Putin and Trump meeting in Alaska to try to see what can happen there. And then semiconductor policy it came out last week and it's continuing as of now. These are big things that could really drive the market either up or down, but it's like, okay, we're just gonna treat this as more of a day off. Then Vice Fed Chair Michelle Baumann, she came out and said on Saturday, I guess they don't take weekends there. This is FOMC, the Federal Open Mouth Committee, said that 3 rate cuts could be appropriate this year. The market could have just skyrocketed to the moon because usually in this particular context over the last few years, when they come out and say they're going to cut rates, that usually really bumps things up. And citing a recent softening in the labor market. That was the weaker than expected employment report that came out August 1st on Friday, and we gapped lower because of that. So you're getting more and more folks starting to say that. And that's why the market is saying, all right, okay, we're probably looking at a rate cut in September. Now, it should be the other way around. And I've explained this over and over again. Since the great financial crisis, the market follows the Fed. Now, the market's always been in tune with the Fed, even before that, when Greenspan was in there and Bernanke was in there. But it should be the market tells the Fed this is what should be happening. It's pretty much a reverse of what it had been historically. All right, the Trump administration is developing a list of possible Fed chair nominees. I'm not listing their names here because they're probably people you haven't heard of, and some of their names are hard to pronounce. Just they're jockeying around to see who's going to be the next Fed governor, or the Fed chair, I should say. And then semis ended up closing down. There was a report that came out that said that some of these semiconductor companies, they'll give up 15% of their AI chip sales in China to the government in exchange for export licenses. Well, that was taken more as negative. But we did have a couple of companies that are semiconductor companies reported, Micron and Intel. They were up strong, but stocks like NVIDIA, AMD, they took a bit of a hit. And Treasury Secretary Bessent said that tariff rates may be subject to a reduction for countries in which the U.S. sees a decreased trade deficit. So it's like, okay, we're not only coming up with what we're going to put in place now, but we're going to work with you going forward. And if our deficit is decreasing with you, we might reduce some of those tariffs there. He also said he expects trade issues to be largely sorted out by the end of October. Okay, he's been throwing out timelines pretty much ever since he's been in there. And the market's like, okay, we'll kind of go off that. We'll keep that in the back of our mind, but let's see some kind of an actual deal. End of October. Well, that's Halloween. That's baseball playoff time. We'll see. There's a lot of stuff that can happen between now and then. President Trump did sign an executive order extending the tariff truce with China for an additional 90 days. This is why we gapped higher when we finally got out of that range back in June. There was just a kind of an announcement that there's a deal between the US and China, and we gapped higher and we've been going up ever since. Had very little impact in Monday's session. And Trump and Putin will meet in Alaska on Friday to discuss the end of the war in Ukraine. And then Zelensky, he's coming out because he's the president of this country that they're invading over here saying, I live in this part of the world. He told other European leaders that he's not willing to concede any territory that is currently held by Ukraine. But territory that Russia currently occupies could be negotiated as part of a ceasefire deal. So now other reports that I saw earlier on, Zelensky was just saying, we're not giving you anything. This seems to be a little bit of a walk back with that. Now, I could be wrong. I don't know the context of the statements that were made there, but it seems like he's willing to at least say, okay, these areas that are truly conquered, we might be willing to give those over to Russia. We'll see. And then you have the other side that says, no, not an inch of Ukrainian territory should be given up to Russia. They invaded. They're currently not really winning. It's just a lot of people are dying in the process. And Trump just says, I want this to end. I want the killing to be over with. There's really no leadership going on here as far as Russia really coming in and quickly taking over. That was the thought at the beginning, and it's been going on for years now. Okay, and the parabolic SAR, this is one of our primary indicators. We had enough of an upward move in Monday's session to turn it positive. We now have a dot underneath, and I'll show you that chart. We only have one thing that's looking extreme, and that's the Sean trend meter. And the trend is still holding up for right now, but we don't have anything in the short term, showing no conviction in the short term, and only one thing in the intermediate term right now. You've got a market that's just kind of bouncing around like bumper cars. So we'll hope that some clarity will come out with the economic reports as other geopolitical things develop. Will the market start to develop a conviction one way or the other? It's still defaulting to the positive side because we're still above all the moving averages, but we're also seeing some cracks under the surface as well. And then no change to the scenario other than a likely rate cut in September. And I came to that conclusion over the weekend, looking at the Fed watch tool charts and seeing such a high percentage there. And then the dollar was up, interest rates were down. We're at 4.27% with the 10-year yield, where after Friday we were at 4.29%. Sentiment ticked down a notch. We were slightly lower with the S&P, so we ticked down to 58, but we're still positive there. And we saw a big bump up in Friday's session when we broke higher. And as far as our trend, we are still positive. The green line's above the red line, but we're below the moving average. That's a weakening trend, but we're still above 20. Now, if you watch the weekly video, we're below 20 on the weekly trend chart. That's the ADX. So it shows that we're not trending in a longer term perspective, but we're still trending on the daily side, but it's a weakening trend. Because of the slight down day, we're negative with the bias. I'm still keeping the momentum at mixed to positive. Now, the reason why it's mixed is we're still seeing a lot of negative divergences. And I pointed those out last week. I pointed them out over the weekend. I'll continue to point them out now. It doesn't mean things will automatically play out that way, but a lot of times, especially when we see a lot of negative divergences coming together, it tends to precede what happens with price, and that would be more negative. All right, so we didn't have any economic reports, which is strange. We didn't have any on Friday, we didn't have any on Monday, but we're going to get a slug of them as the week unfolds here, so there's nothing to show you there. Now, we see this chart, it doesn't really change all that much. This is just telling us what we've known now for years. Stocks are overvalued, they're expensive, but they've been over expensive for quite a while. You can see here with the NASDAQ 100, which is growth, we're up to 28 now, which we get concerned when it goes above 20. Market's not going to really concerned about that. Now, this is the one that's a bit of a contradiction because I also look at the valuation. I think it's based on the S&P 600, which is another small cap index. That's down around 15, 16 or so. But when you look at the Russell 2000, that's at 23. Small caps have already been underperforming and they're still overvalued. They really haven't been participating all that much with the upward move that we've been seeing, especially going back to October 2022, and then coming up out of the lows that we saw back in April of 2025. Then the S&P itself, that's still overextended at 22, where 20 and above is considered to be expensive. Where here you look at the historical average, it's well under 20, but a little bit over 15 here. Then you look at the equal weight, where all stocks are treated the same. That's coming in at 17. And then the mid caps, which last week they really underperformed. Small caps actually outperformed mid caps, and they've been really languishing lately. They're coming in at 16. All right, then mega cap growth and tech positioning, still below the dashed line here, which is the median, or you could say like an average, but we're slightly above zero. Since we really came down with the April lows, we've been fighting our way back up. Not overly positive, not overextended to the upside, but still looking more positive. And the forward PE here, just showing us what we kind of saw just a moment ago here. You take the aggregate index, that's everything together, we're at 22. That's the S&P itself, and that's looking forward. We also look historically, and we're overvalued in that aspect too. So no matter how you look at it, we're overextended. But when you just look at the equal weight, That's at 17. Most of the stocks in the S&P are not necessarily overvalued. It's a few. It's the big mega caps, the stocks that everybody knows their name, everybody wants to own some of them, high trading, high volume type of stocks. That's what really is driving things up. Now, what really bumped up the PE ratio last week was Apple. They're huge, and they had a very, very good week, and so that really helped the index itself to go higher, which also means that the PE ratio went higher. All right, discretionary investor positioning is well below levels. These are people that can kind of pick and choose. Okay, I think it's a good time to get in, as opposed to the systematic approach where you just like, I follow a system. I don't really, I throw my money in. Maybe I do dollar cost averaging. If the market's down, okay, the positive take on that is it buys more shares. When it's going up, I'm happy because now the overall value of my portfolio is going up. And this is the earnings per share measure that we see here, the dark blue line. This is a revisions ratio. I mean, it's not enough just to come out and say this is what we're going to do. They come out and they actually measure the revisions that have been made to earnings per share, but it's lagging behind a little bit. So folks that try to pick and choose when to get in and out of the market, that's underperforming according to this chart. Financial group positioning. Now, I've been concerned about the financial sector. If you watched any of the videos for the last week or two, we're still seeing where the financial sector is underperforming the S&P. We have a ratio, and I'll show you a chart later on. The financial sector itself is doing fine. You look at just the sector, yeah, no problem. But when you compare it to the S&P, it's really underperforming. And this is showing maybe prices are low enough, maybe that underperformance is low enough where we're seeing some buying starting to come back in. All right, international stocks, pretty much for all of 2025, US stocks have been recovering and starting to do better shorter term, but in the bigger picture, US stocks are continuing to underperform global stocks. And I hit that over the weekend in the weekend videos and intermarket analysis video. And we really try to keep an eye on that because US stocks typically take a leadership role. But in 2025, global stocks have actually been doing better. Realized and consensus. Realized just means you take inflation into account, and consensus earnings per share growth in select US equity indexes here. This is the S&P, and we're looking at 2025, and then it's going up going forward. That's why prices are overvalued, because earnings are projected to go up. And you can see the equal weight is going up. We do see a drop off here with the NASDAQ 100 going forward. That could be negative. But when you look at the mid caps, and of course, they're very optimistic about the small caps, they're just going to go to the moon. We just don't really see that happening in real life. All right, then these are different set of charts here. This is SLOOS. This is the Senior Loan Office Opinion Survey. Gotta love that acronym there. It says net percent of banks reporting stronger demand for C&I. That's corporate and industrial loans. To large and medium-sized firms, it's going down. Now, it slid to minus 28.6. The worst performance, blah, 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 blah. I don't like it when they do time comparisons because what was the context? What was happening in the fourth quarter of 2023? Well, it wasn't that long ago, but things are different now. But this is going down, and that could end up helping or hurting small and mid caps because these companies need loans to grow and to expand. And if their loans are actually dropping off, that's seen more as a negative thing. All right, then 10-year, this is looking different ways at the 10-year yield, which is what I follow the most. I know a lot of people follow the shorter end of the yield curve, like the 3 month, the 2 year. I tend to focus more on the 10-year. That's the benchmark. And so many things are tied to the 10-year. But it says for the last 3 years, changes in nominal 10-year yields, that's just a basic change, have mostly come from shifts in real yields. That's with inflation included there, not from inflation expectations. Okay, the real swing factor is real yields, and right now they're the only thing that can actually push nominal rates down. Okay, we're still in a lower inflationary environment overall. Okay, then we have hedge funds, and how are they investing in the Russell 2000? In the past two commitment of traders reports, These are reports that come out from the futures market. They're released, I believe, out of Chicago, from the Chicago Board of Trade and places like that. It, they come out with these things, and there's a bit of a delay in them, but we can still get some information from that. Hedge funds, Russell 2000 shorts. These are people or hedge funds that are actually short the small caps right now. And what that means is that they want prices to go down. And it surged to a new record. Now, that could also be a contrarian type of a thing here. You can see we're getting a very low reading. Specifically from July 22nd through August 5th, hedge fund short sold 4.3 billion, the largest in 10 years, blah, blah, blah. The resultant level of outstanding shares in notional terms also marks a new high. Okay, so you kind of have to read this kind of like the VIX, where it's going down. That means there's an increase in shorts. That's negative in and of itself because you have a lot of, again, I call hedge funds the big money, not necessarily the smart money. And if they're wrong, and sometimes they do get things wrong, and they get things catastrophically wrong, that means they have to buy these stocks to close out those positions. And that produces a built-in sideline of buyers where if things start to really move, they have to buy to get in, and that could really pump up small caps. So that could end up being positive if it plays out that way. And earnings surprises, says second quarter earnings are nearly quadrupling preseason estimates. And that's what companies do. They come out earlier before their report comes out and say, "Yeah, this is what our report's going to be." And then when it's finally released, it's like, "Oh my gosh, we are so surprised to the upside here." That's a manipulation that goes on, and people know it, but people still play the earnings type of strategies. There's a lot of people that do that, but the volatility can be really crazy during those times. So it just means that they're coming out and having better than expected earnings reports. And earnings revisions also coming up here. The percentage of S&P 500 companies with positive 3 months percent changes in their forward earnings jumped to 84.1% last week. Okay, and then this is just bodes well for the bull market and suggests that it could broaden in the coming months. Well, let's get through August and September and see if it ends up playing out that way. But we have been seeing an improvement here with earnings. That's what's been keeping the market together right now, is that we're having a pretty good earnings season. All right, here is the chart. Higher open, we did go above the unchanged level and then immediately fell back. We just chopped above and below the unchanged level. Somebody or a group was trying to drive things up. We finally broke out here, but we got stalled right at R1. That was where we set the high, right there. And then we just spent the rest of the day coming down. We did go all the way down to S1. Now we closed up off of that, which is somewhat positive, but you take all of this together over a few hours of period of time, and that's what I call late day selling. And that's not a positive thing to see. Here's the intraday chart, not much of a change. And again, I say this and then usually the opposite happens. Expect things to be a little bit quiet before the market opens. Actually, an hour before the market opens, because that's when CPI comes out. It's released an hour before the stock market opens itself. We're still looking good here. Intraday chart of growth to value. The blue line still above the red line. And after really taking a big hit here, with both right at the beginning of August, we have been bouncing back. The bigger picture is you go back to May, and this is tending to trend higher overall. This is also looking fairly positive. Not a great day on Monday, but you go back to the beginning of July when the growth to value ratio really took a hit, and for the most part, it's still going up. Then our end of day charts where growth was down less than value, everything was down here. We started off really positive. That's why I say that it's the amateurs who open the market, it's the professionals who close the market. That's why I say right around lunchtime, that's when I really start paying attention to things. And growth was down more for the mid caps, and where growth was actually down very little here with the small caps, and value was down more. So we look at our small cap growth to value ratio, really chopping along lately, but the small caps have not really been performing all that well. Mid caps just chopping along sideways, a little bit of a hit with their growth to value ratio, and a little bit of a tick up after taking a hit on Friday with the S&P growth to value ratio. But in the bigger picture, This is still positive. That's why if we do see a decline that develops at some point in August or into September, we're going to be watching these values. If they're still holding up while we're going down, that just means it's a normal pullback. And even if we see a little bit of weakness here, that it still could keep it in more of a positive stance because the bigger picture, the stock market is still holding up fairly well. All right, and we're doing okay here. No change with the growth to value ratio here, where we did set a new all-time high after Friday. Still positive, but underperforming here with the discretionary to staples ratio, but we're still above the moving averages. It ticked up just a little bit, but it's been chopping along sideways recently as well. So here we look at the short-term trend, trying to turn up with ADX, but we're still below the moving average. That suggests the trend is still weakening, but we're still above 20, so we are trending. We're positive with the green line above the red line. Intermediate term, trying to turn up a little bit here, but we're still positive and above 20 with the intermediate term trend. That is still hanging on to positive. We have now spent the last two trading days below average with volume. You can see Friday and then Monday's session with the red histogram. And then we get this every week. This isn't fast enough for me. I like to look at the fear and greed index from cnnmoney.com because that updates multiple times throughout the day. But this one that's a composite of a bunch of different sentiment gauges coming in at 66.9, that's still positive. Where I don't see it as greed, I see this as positive. I see this as negative, where it's over here in fear. When we start to get concerned is when we go above the 75 level. That's when we're extreme positive, where they say extreme greed. And over here on the left-hand side where it's green, because they're thinking that's a good time to buy. We camped under there for most of April, and that's where I would say extreme negative. But that's just the way I look at this. All right, then insider transactions ratio. These are legal insider transactions. Still down below this black line, which could end up being a bit bullish for stocks. And we're still under 20 with the VIX. We did tick up a little bit, but still below the moving averages with the both with the line chart and the bar chart. But this is what we're watching right now. This was updated recently here when the VIX really spiked up after we had that down day a week ago Friday. But this is typically what happens. Doesn't mean it's going to happen. This is just an average of historically what has happened. When we get into August and September, even into late October, possibly into November, where the VIX has a tendency to really go up. And that means stocks are going down. And we did tick up just a little bit above the moving average with the VIX of the VIX, with the bar chart and the line chart. We ticked down with this fear gauge. We ticked up a little bit with this other fear gauge. So no real confirmation there. And we're level now with the equity put call ratio. This could be some hedging that was taking place last Friday. That's when we saw this ticking up. And they just are holding on to those hedges because CPI is coming out on Tuesday. Now, that's if you try to apply common sense to the market, which can often be a dangerous thing to do. And we're ticking back up a little bit after we really dropped off with the 5-day chart, and we're ticking back up with the 10-day chart. So there's some additional hedging that's still remaining in place. And we ticked up a little bit with the high beta versus low beta, but for overall, this is underperforming. We've been going up with the S&P, and this has been coming down. That just means that when we do go up, it's just a few stocks that are really driving things up. We want to see more broad participation because after we finally hit those lows in April, this has been pretty strong. Now it's pulling back just a little bit. Now it could recover and start to go back up, but if it continues to fall, that's going to cause some more concern. And we're dropping off now with the volatility risk premium. This was that high reading right before the employment report came out August 1st. And we weren't seeing it in the VIX. We weren't seeing it in our other sentiment gauges, but we were seeing it here, getting this very high reading. Well, since that time, it's been dropping down, even though it's not quite down to the band yet. And our advanced decline line studies just kind of trailing on, dropped a little bit here based on price as well as volume, but still in the bigger picture, looking positive. We're still below zero, even though we ticked up a little bit with the 10-day advanced decline oscillator. And we're slightly negative here with the short-term advanced decline ratio, slightly positive with the intermediate-term advanced decline ratio. This is internally. This is showing some weakness where we're seeing a trailing off of the new highs. a bit of an expansion, but not all that much here with the new lows. But that's causing the 5-day moving average chart and the 10-day chart to decline. And that's showing longer term internal weakness in the S&P. So this is one place where we're seeing some negative divergences. We've been going up with the S&P. This has been going down. Now, I'm not quite sure. You want to treat it as positive or negative? We're just about down to the moving average here with accumulation distribution. We also rolled over just about down to the moving average with the boom indicator. Where this had been positive after Friday, it pulled back a little bit in Monday's session. We are negative and actually dropping below the midpoint here with the Chaikin money flow. This is smart money indicator number 2 that's still negative. We came down, but we're still barely above the moving average with the Chaikin oscillator. So not a lot of strength here, but it's not turned over to full-blown negative yet. We did go up a little bit with the vortex of the green line. We came down with the red line. That's still positive. And we're seeing more of a disconnect here with the S&P going up with the bar chart, where the NYSE advanced decline line actually continues to go down. So it's just a few companies that are kind of keeping things together at this point. So coming down, but still above the moving average with the NYSE common stock advanced decline line, still above the moving average with the S&P, coming down above the moving average with the mid caps and below the moving average with the small caps. And still below 50 with those stocks in the S&P above their 20-period moving averages. When it's below 50, that's considered negative. The other moving average studies are doing fine. We're still above 50, even though we declined with the 50-period moving average study, the 100-period moving average study, and the 200. Those are still positive longer term. It's more of a non-conviction that we're seeing in the short term. Here is the daily chart, still looking pretty good. We did set another higher high, even though we were down on the day. This is still a fairly constructive looking pattern when you look at the higher highs and higher lows. Now, you could also make a case that we gap down and this is a bearish flag. Here, I'm not a big pattern person, but there are probably people who are seeing this as well. Well, it hasn't led to a lot of weakness, at least yet. We'll see if that changes as the week unfolds. Then on the bottom, we continue to be below average with volume. We ticked down a little bit below 50 with the 20-period moving average study. We turned down, but we're still above 50 with the 50-period moving average study, and we're just kind of chopping sideways now with the 200-period moving average study, and we're still above 50. So, and these are the charts that are pretty touchy, and so we get extreme positive or negative very easily with these. Stochc RSI, it was a little bit above the midpoint after Friday. Now it's a little bit below the midpoint. And after being extreme in Friday's session, that came down with the Williams percent R, not really showing any conviction with the CCI 14 or the CCI 20. They're still positive since they're both above their midpoints. And usually this is always on the list. The stochastics, well, we were extreme after Friday. We ticked down, but we're still above the moving average. We are improving above the midpoint with the intermediate short-term stochastic. We're turning up, but we haven't quite crossed above the moving average with the long short-term stochastic. And this is just a further subdivision of the short-term time frame. So you have short-term, intermediate short-term, and long short-term. And still barely hanging on to being positive right around the midpoint with the force index. We're also noticing where the Keltner bands, they're like Bollinger bands, they're getting closer to each other, which could produce some kind of a move either up or down. It's like winding a spring. And we are still looking okay here with the 20-period moving average study. Even though we closed down, we're still seeing a pretty healthy bar pattern for the time being, and the green line and the blue line are starting to go back up. And we're above the 20-period simple and exponential moving averages. This is what I use to measure whether we're positive or negative in the short term. And we're still at the high end of the +1 channel with the standard deviations chart. We actually got up into the +2 channel after Friday. We're a little bit below it after Monday. Now, in the bigger picture, I've been pointing this out. We've been going up with the S&P where the balance of power was going down. We're also still negative here since we dropped and we're below zero. As in the short-term time frame, we've been going up with the S&P for the most part, where this has been not getting back above zero and turning positive. We are positive with the no-go with the darker blue bars. And this is more for time, the Landry light. It starts to say, okay, when we get over 40 periods in this uptrend, that's about when maybe it's gone on too long. Well, now we're at day 70, so that's kind of a little bit longer. And we're still positive here with the proper order. That's still painting in bar after bar of an uptrend. And we're still above the midpoint with the highest high, lowest low value, but we're not getting up to the blue line or falling down to the red line. That's showing more of a non-committal um, stance by the market. Now we're still above all three moving averages here. The short term is a 10 period simple moving average. That's flatlining and actually starting to go down ever so slightly, but price is above all three lines. We're still going up with the 20 and the 30 period exponential moving averages. This is the intermediate term trend based on 50 periods. We're still going up with the red line and the blue line, even though we're below the red line. Prices have held up enough to keep those lines going higher. That means the intermediate term trend is holding up, at least for right now. And we're above all the moving averages here, the 20, 50, 100, and 200 period moving averages. And we're above all the anchored moving averages. And as I pointed out last week and over the weekend, this was that gap up when a big trade deal was announced, and then we shot higher after that. This is an anchored moving average from that breakout spot. So if we do start to fall, we're going to be watching this level to see if it provides some kind of support. And we're still seeing a negative divergence here. We've been going up with the S&P where we're going up before that. That whole time, about halfway through July, the TTM squeeze has been going down. And we're just barely above zero here with the ease of movement. We just hang on a little bit above zero, then we drop a little bit below zero, then we go a little bit above zero again. And not extreme, still positive though. When we look at the Arun, it shows that the buyers are dropping off, but now the sellers are dropping off as well. We're still above zero with the oscillator overall. That's still positive. And then the S&P McClellan oscillator, still below zero, and it declined here. And when that's negative, we continue to decline with the summation index based on price and volume. We're still below zero and declining with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume for the NYSE. Now, all last week, we saw the Shrunland trading oscillator going up and it finally crossed above zero based on price and volume. It picked up some weakness in Monday's session and now it's turned negative based on price and volume. And we're still not looking good from a momentum standpoint. We're below the moving average, below the red line. We're no longer extreme and we're declining. So you take this PMO by itself and it's negative. Then we break it out based on price and volume, still seeing a decline there as well. That's negative. And we've been seeing some negative divergences here. We were going up with the S&P. We were setting lower highs. So far, with the PMOs that are rising, these are PMOs inside of the S&P 500. We also have been going up. We're seeing the buy signals trailing off. And we were getting a really high reading going back about halfway through May until the latter part of July. The PMOs that are above zero was hanging on to, excuse me, a very high reading. That continues to drop off. And we're trying to improve here in the short term because we're going up here with the bars. So the slope oscillator is improving, but it's still negative. It hasn't crossed above its moving average yet. Trying to turn up, but still below the moving average with the MACD. So you look at all of our oscillators, short, intermediate, and long term, they all continue to be negative, even though some of them are trying to improve. We're still negative with the Copic curve. We're still above 50 with the money flow. That means there's more money flowing into the market than is actually coming out. And we're turning back more positive. We had dropped below 50 with the ultimate oscillator. Now we're going back above 50. That's positive there. And the Sean trend meter, even though it declined, it's still up in this kind of darker green area above the red line. So that's why it's the only thing on our list that's looking extreme, and even it went down. We're still above the moving average. You see all this choppiness here with the unbalanced volume, but we're still above an advancing moving average. We're still above 50 with the intermediate and short-term RSI. And we've been that way going back to the latter part of April when things finally started to be breaking to the upside. So that's still positive there. And we're still positive with the Elder's Impulse system for the S&P. This is kind of a big change. We had enough of an upward move to draw a dot underneath with the parabolic SAR after it had been negative. And we're also positive on the weekly chart as well. And we did advance, and we're actually turning positive with the bullish percent index. We had enough of an upward move here to cross back above its moving average, and it's above 50. But you look at the NASDAQ 100 bullish percent index, it's setting intraday all-time highs here, and it's going down below 50. That's another negative divergence. And we're just kind of chopping around, but still above 50 with the NYSE bullish percent index. And I count it as positive since it's above 50. And here is the weekly chart of the S&P. We still want to watch this R1 level. If we do break to the upside, we're going to be watching 64.68. That's rounded up here to this R1 pivot point. And sometimes these pivot points play huge roles. You can just go back and see where they had real big impacts, and especially lately. Now, they program this into a lot of the algorithms and the program trading. These are computers that trade instead of people. Yeah, they have these sitting in there in their algorithm, and if we get up to this level, we might hit that and say sell, 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 sell. So we'll just have to see. Or if we hit this and then go above it, those algorithms might say buy, 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 buy. So we just want to watch this and see how it all comes together if we get to that point. But from a trend perspective here, the Heiken Ashi is positive. The Kigi chart is black and pointing up. That's positive. We're positive with the Renko chart, and we're turning back and looking more positive with the three-line break. So a trend study that we do, we're still in an uptrend. It's just when we look under the surface. Now, with that move up that we saw three more X's drawn in Monday's session. We're not setting a new high here yet, but we after the big drop that we saw on Friday when the employment report came out, we did see three new X's coming back in, just matching this previous high on the point and figure chart. Then long term, we're still looking pretty good here. We're well above the midpoint, just kind of meandering around with our 150 and 200 period moving average study. Then you get to see this chart. I don't show this, I mention it, and I talk about it in some of the weekend videos. This is a very long-term oscillator. We didn't have any signals from this oscillator in 2024. That's why I don't show it every day. Well, we're just getting ready to cross above the red line, and that would turn this long-term positive. And that also could bode well, where if we do go down in August at some point in September, and this continues to be above the red line, that could also suggest longer term we're still holding up. Now, we were still below this, so it was still treated as negative, but it had been improving. Now, the weekly chart is positive. It came all the way down to its red line, and now it's starting to bounce up off of that. So if this can get above the red line and stay above it, we would have the daily chart and the weekly chart confirming each other. And no changes here. Mid cap still underperforming in the short term. Everything else is still positive. Commodities are still negative in the short term. Bonds are looking better in the short and intermediate term. And we had enough of an upward move to be in an uptrend now in the dollar in the short term. And we saw communication discretionary. Now, healthcare was up just a little bit here, but these are the two big growth areas, communication and discretionary. Now, tech, it would have been nice if it had a little better day, but it really didn't. So, and we saw energy being down the most. So we had the NASDAQ setting a new all-time high. NASDAQ 100 did also. That's intraday. And then the S&P got above 6,400. Didn't stay there, but it did get above that. And then the Dow dropped down below 44,000. So an awful lot of red by the time we got close. Not big red. See, less than a percent decline with NVIDIA. Apple, which just went through to the moon last week, seeing a little bit of profit taking there. Microsoft was down just a little bit. These are the big tech stocks. Tesla was up. That kind of held up discretionary, but Amazon was down slightly. Then we had Google and Meta also dropping as well. That's why it ended up not being a really good day. So still seeing a bit of a disconnect here with the S&P weighted index going up. We're seeing the equal weight on a closing basis continuing to go down. And the Dow, which just cannot get above this pivot point. It was down 0.45%, but it's still in a longer term uptrend. We're neutral with the diamonds looking at the Dow. And we did set an intraday high here with the NASDAQ, but not a closing high. It ended up being down 0.3%. It's still positive, though, with the Elder's Impulse system. And we came close to this R1 level, but not quite there yet with the NASDAQ 100. It also closed down 0.36%, but it's still positive when we look at the Qs for the Elder's Impulse system. We are improving with momentum of the NASDAQ 100, but we're not above the moving average yet. And longer term, and I tried to extend this line out a little bit. Now, again, I draw this. I'm trying to connect this low to these lows set back in 2016 and then just extend that forward. That's the goal here. And the way I learned technical analysis, that's what you're supposed to do. You can draw these lines every crazy which way you want and come up with any scenario that you already predetermined you should come up with. But we are above this longer term trend line. So we were able to get above it before, but we weren't able to stay above it. But longer term, this is still looking positive. And here we have the S&P 600 small cap still not generating a golden cross. They actually held up a little bit better. They were down 0.13%. We did generate a golden cross with the Russell 2000 right at the beginning of August, and they were down 0.02% and still holding above their moving averages. Neutral with the Elder's Impulse system for the small caps. Mid caps were down, dropping below their 50-day moving average now. Haven't seen that in a little while. And here is the mid cap going from neutral back over to negative with the Elder's Impulse system. The Wilshire was down 0.25%, kind of been matching the bar pattern that we've been seeing with the S&P. Also down slightly with the total US stock ETF. And here's the financial sector. Virtually unchanged, down just a little bit, back down to their 50-day moving average. This is not a bad looking chart on a trending basis when you look at it all by itself. It could be stronger, but it could be an awful lot weaker. Where it's underperforming is when we do a ratio with the S&P. We generated a death cross last week, actually right at the beginning of August, which I guess would be last week, with this ratio, and we're dropping further below the 200-day moving average. Now, we ticked up a little bit on Monday, but we want to see what it was doing here back in 2024 and into early 2025 when it was outperforming the S&P 500. Now it's underperforming, and we don't know. We're seeing some weakness in the regional banks as well. Is this a warning sign that we're seeing ahead of time? It could turn out to be nothing, but we just want to know about this ahead of time, saying, the financials have really been underperforming. And if the banks aren't happy, a lot of times the rest of the market isn't happy. And the financial sector is more than just the banks, though. The FANG index, it was down, but still a fairly looking recent pattern here that's looking positive, and we're still in an uptrend. And we did improve a little bit with the semi to tech ratio, and it's not that semis did all that great, it's that tech was down, and so we're seeing this bouncing back up. But the bigger context is that the semis have been underperforming. We want to see this ratio continue to go back up. So Apple was down 0.83% after just having a monstrous week last week. Amazon down 0.62%, still above its 50-day moving average. Microsoft virtually unchanged, still in an uptrend, still above the moving averages. Google is in an uptrend, down 0.21%. Meta down 0.45%, just kind of chopping sideways recently. NVIDIA was down 1/3%, a little bit more than that, still in an uptrend. Tesla, it was up 2.85%, but just kind of meandering above and below its moving averages right now. Netflix was up over 0.5%, still trying to get back up to its 50-day moving average. And we're seeing a little bit of a drop off here with the correlation between world and US stocks. That's dropping off a little bit. We continue to drop with the longer term correlation, but it seems to be leveling out slightly here. And we're going to keep an eye on oil. We'll see if anything that develops with the summit in Alaska this week, if that has any impact. Anything developing, either positive or negative in the Middle East, could also have an impact on oil prices. And the dollar back above its 50-day moving average again, even though it's in a longer term downtrend. And still below the 4.5% level with the 10-year yield, even though interest rates, well, here it shows, they declined a little bit. I thought they went up. And we went up a little bit here with the 10-year based on price. Okay, could be wrong about that. So the Q's to S&P ratio, that's still looking pretty solid. The discretionary to staples, not so much. It's trying to get back up to its moving average, but we are still looking solid when we compare large cap growth to value. So we're above the moving average with the large caps, below the moving average with the mid caps, coming up, but still at the moving average with the small caps. All right, so we're still dealing with earnings season. It's not as big of a deal. Most of the S&P 500 companies have now reported, but that can still have an impact. We're still positive on all time frames, but we're seeing a lot of these negative divergences. And like the summation index based on price and volume going down as the S&P has been going up. That's another negative divergence, and other ones that I went through. We're going to get CPI. That's pretty big. And we're going to get the Treasury budget later on in the day. And then I've been talking about all the different geopolitical things that any one of these could come to the surface and have a real impact. Even though there's a lot that the market is dealing with, it didn't have much of an impact on Monday. So then Wednesday is going to be pretty light. Every week we get the MBA mortgage applications. Then we're going to have another big day with jobless claims, continuing claims, and PPI. Friday's going to be a big day with retail sales, industrial production, and capacity utilization, and then consumer sentiment as well. So here is what we're looking at for CPI over here. We'll have to see if it comes in greater or lower than expected. Seasonality wise, not really leaning in the positive direction. We are dealing with options expiration. Friday will be options expiration day where we're up a little bit more than down. But for August 12th, going back to 2002, we're negative with the Dow and neutral to negative with the S&P and NASDAQ. This also shows during a post-election year, I'm mainly following the green dash line where we tend to see some seasonal weakness. Doesn't mean it's going to happen, but historically it has happened, and so we want to know about this beforehand. And going back to 1950, we have yet to have a positive August in a post-election year. Also, post-election years tend to not do well, according to the Carson chart. This has actually been updated. I've been showing this chart, but they included, as of Friday's close, where this is where we often see some weak historical tendencies here, heading this way a little bit into October. All right, so now, okay, I messed this up a little bit. Um, our three smart money indicators are now leaning more on the negative side. Accumulation distribution, they're right on top of their moving averages there. Chaikin money flow is clearly negative. We did decline with the Chaikin oscillator, but we're still above the moving average. And as I just said, the McClellan oscillators and summation indexes, they're going down, both for the S&P and NYSE. Okay, the parabolic SCR. No, okay, that's a mistake. This should actually be over on the positive side. The Swelling Trading Oscillator, it was on the positive side. Now it's over on the negative side. We're still below 50 with the 20-period moving average study. And okay, all right, it's after Monday here. Forgive me. The NASDAQ one, I meant to change the bullish percent index. That should be BPI right there. And then the momentum oscillators for the S&P continue to be negative, and the momentum for the NASDAQ 100, though it's improving, has not crossed above its moving average yet. And then we are in the process of crossing positive here with the long-term special K chart, which I did finally show here. And then the Johor, easy for you to say, Zohorchak, good old strong, solid Midwestern name there. It has a sell signal. Now we were at a full -10. I showed that over the weekend. We've improved to a -6. It's still negative, but improving. All right, then the positive side, growth to value, discretionary to staples ratios, they're still in uptrends. And here we have the S&P and NYSE bullish percent index. Now the NYSE is positive because it's above 50. The S&P bullish percent index is positive because it's crossed back above its moving average. The ease of movement, money flow, and ultimate oscillator are positive, as is the vortex. And the financial sector by itself, it's just that underperformance that we're seeing when compared to the S&P. Here are the pivot points for Tuesday, which have already been updated on the YouTube community tab and are also pointed on the website. All right, so our conclusion, positive. Are we seeing some weakness? And then in the short term, we're not really seeing no conviction right now, and we're still dealing with a weakening trend. And we're seeing some negative divergences here that could be leading to some weakness in the intermediate term. It's holding up for right now. We're just seeing these clues ahead of time, which again, positive reports come out, the market takes it as positive. We could blow all those negative divergences away. But they're still developing, and they've been developing now through most of last week and so far into this week. But we're still looking quite positive here in the long term. Thank you. I hope you found this helpful despite the mistakes. And have a great day, and I will talk to you in the next video.